13.38% yield, 8.41% yield, 8.57% yield. 3 monthly dividend exchange traded funds. But here's what nobody tells you. The highest payer just cost investors 23.91% in share price over 5 years, while the lowest payer delivered 66.10% total returns. Your monthly income strategy might be bleeding your wealth. Every month, hundreds of millions flow into these 3 funds. JEPI holds $41.28 billion in assets. QYLD manages $8.14 billion. Investors chase the monthly payments. But the real question isn't which pays the most. It's which one actually builds wealth while paying you. Quick note before we dive in. This is education, not financial advice. I'm showing you the math and the trade-offs. You make your own investment decisions based on your situation, but this comparison might completely change how you think about monthly dividend investing. We're breaking down 3 completely different strategies. One sacrifices growth for massive yield. One balances both but caps your upside. One adds market protection but charges a premium. By the end, you'll know exactly which fits your wealth-building stage. Meet Harry. He's got $100,000 to invest. He wants passive income, specifically money hitting his account every single month. Not quarterly, not annually, monthly. He discovers 3 ETFs that all pay dividends 12 times per year. He sees that 13.38% yield and thinks, I could be collecting over $1,100 every month. Harry buys in. The first payment arrives, then the second, then the third. But 6 months later, he checks his portfolio and something doesn't add up. His monthly payments are solid, but his account value? Down. He's collecting income while his principal shrinks. That's when Harry realizes he didn't understand what he actually bought. Let's start with QYLD, the Global X. NASDAQ, 100 Covered Call ETF. This is the heavyweight champion of yield. 13.38% annually. That's $2.23 per share in dividends every year. On a $10,000 investment, you're collecting $1,338 annually. $111.50 hitting your account every single month. Here's how it works. QYLD owns the NASDAQ 100 stocks, companies like NVIDIA, 9.69% of holdings, Microsoft, 8.73%, and Apple, 7.98%. Then it sells covered call options on those holdings. When someone buys those calls, QYLD collects the premium. That premium becomes your dividend. The expense ratio is 0.60%. You're paying $60 annually on that $10,000 investment. Reasonable for the strategy complexity. But here's the catch Harry missed. Over the past 5 years, QYLD's price performance is negative 23.91%. Your shares lost value. Yes, you collected dividends, but your $10,000 investment dropped to $7,609 in share value. Add back the dividends, your 5-year total return was 40.48%. That's $14,048 total value. Not terrible, but here's the problem. The S&P 500 total return over the same period? 101.40%. You would have had $20,140. Why the underperformance? Covered calls cap your upside. When NVIDIA explodes 150% in a year, QYLD doesn't capture that. It sold the upside for premium income. You got the 13.38% yield. You gave up the growth. Now let's look at JEPI, JP Morgan Equity, Premium Income ETF. This is where $41.28 billion in assets lives. That's 5 times larger than QYLD. Why? JEPI's yield is 8.41%, lower than QYLD. But here's what changed. The 5-year total return is 66.10%. Harry's $10,000 becomes $16,610. Plus, he collected $4,205 in dividends along the way. The strategy is different. JEPI doesn't just own stocks and sell calls. It uses equity-linked notes, basically derivatives that track stock performance. combined with covered calls on large-cap U.S. stocks. The top holdings include Alphabet, 1.79%, Meta, 1.66%, AbbVie, 1.63%, MasterCard, 1.62%, and Microsoft, 1.62%. Notice something? These aren't just tech stocks. JEPI spreads across technology, 20.20%, healthcare, 13.64%, financials, 13.55%, and industrials, 12.96%. It's diversified beyond NASDAQ concentration. The expense ratio is 0.35%, almost half of QYLD's. On $10,000, you're paying $35 annually instead of $60. The monthly dividend? $4.78 annually per share. On a $56.91 share price, that's consistent monthly income. Not as high as QYLD's 13.38%, but your shares aren't bleeding value. But there's still a trade-off. JEPI's 5-year price performance is only 7.65%. Your share value barely grew. The 66.10% total return comes mostly from reinvested dividends, not capital appreciation. You're still giving up growth for income, just less dramatically than QYLD. Enter QQQH, the NEOS NASDAQ 100 Hedged Equity Income ETF. This is the smallest fund, $347.79 million in assets. But it's doing something the other two aren't. The yield is 8.57%, basically identical to JEPI. The annual payout is $4.67 per share. The expense ratio is 0.68%, the highest of the three. But check this year's performance. QQQH's year-to-date total return is 12.24%. JEPI's 4.69%. QYLD's negative 0.90%. QQQH is winning right now. Why? The hedge. QQQH owns the NASDAQ 100, heavy tech exposure with NVIDIA, 9.57%, Microsoft, 8.35%, Apple, 8.06%, Broadcom, 5.75%, and Amazon, 4.98%, as top holdings. Technology makes up 54.56% of the portfolio, but here's the difference. QQQH buys protective put options on the index. If the market crashes, those puts gain value. QQQH cushions the fall. You still collect your 8.57% yield. But you're protected on the downside. The cost? That 0.68% expense ratio. You're paying $68 annually on $10,000 for that protection. And here's the other cost. When markets rip higher, those puts expire worthless. You paid for insurance you didn't use. Look at the 5-year total return, 51.60%. Better than QYLD's 40.48%. Worse than JEPI's 66.10%. QQQH sits in the middle. Growth potential with downside protection. But there's a catch Harry needs to consider. QQQH only has 5 years of dividend payments. JEPI has 4. QYLD has 10. Track record matters when you're betting on monthly income. Here's where Harry finally understands what happened. He wasn't comparing the ETFs correctly. He was obsessed with yield. He should have been focused on total return and how he uses the income. Let's run Harry's $100,000 through 2 scenarios. Scenario 1. Harry spends the monthly income. With QYLD, he collects $13,380 annually. Over 5 years, that's $66,900 in dividends spent. His remaining shares are worth $76,090. Total value, $142,990. Initial $100,000 plus dividends spent plus remaining value. With JEPI, he collects $8,410 annually. Over 5 years, that's $42,050 spent. His shares are worth $107,650. Total value, $149,700. With QQQH, he collects $8,570 annually. Over 5 years, that's $42,850 spent. His shares are worth $101,820. Total value, $144,670. If Harry's spending the income, living off it, JEPI wins. Better share price stability plus solid income. Scenario 2. Harry reinvests every dividend automatically. With QYLD, those $13,380 annual dividends buy more shares each month. The 5-year total return of 40.48% compounds. $100,000 becomes approximately $140,480. With JEPI, the 66.10% total return already includes reinvested dividends. $100,000 becomes $166,100. With QQQH, the 51.60% total return with reinvestment gives you $151,600. If Harry's reinvesting, building wealth for later, JEPI still wins. Better compounding because the share price didn't collapse. This is where everything clicks for Harry. The best ETF doesn't exist. The right ETF depends entirely on where you are in your wealth-building journey. Phase 1. Accumulation, 20-plus years from retirement. Harry's 35. He doesn't need the income yet. He needs growth plus income. He picks QQQH. Why? The 8.57% yield provides some cushion. The NASDAQ 100 exposure gives growth potential. The protective puts limit catastrophic loss. His monthly $714 in dividends auto-reinvest into more shares. In 20 years, he'll reevaluate. Phase 2. Transition, 5 to 10 years from retirement. Harry's 55. He's got $800,000 built up. He doesn't want to risk a 50% market crash wiping out decades of work. He shifts to JEPI. The 8.41% yield gives him $67,280 annually. He can choose to reinvest or start test driving retirement income. The diversified holdings and lower expense ratio, 0.35%, protect his nest egg. Growth is slower, but preservation matters more now. Phase 3. Distribution, living off the portfolio. Harry's 65. He's retired. He's got $1.2 million. He needs maximum monthly income. Now, QYLD makes sense. The 13.38% yield provides $160,560 annually, $13,380 every month. Yes, the share price might decline over time, but Harry's not reinvesting. He's spending. The high yield funds his retirement. The NASDAQ 100 exposure still gives some inflation protection through tech growth. 3 ETFs, 3 strategies, all pay monthly, none are wrong. QYLD delivers 13.38% yield by sacrificing growth. Your shares decline, but income is massive. Perfect for distribution phase. JEPI balances 8.41% yield with 66.10% 5-year total returns. You give up explosive upside for stability, best for transition and early retirement. QQQH offers 8.57% yield with protective hedging. You pay 0.68% in expenses for downside protection. Ideal for accumulation with safety. Harry learned the hard way. He bought QYLD at 35 because he chased yield. 5 years later, he realized he should have been in QQQH or JEPI, building wealth, not just collecting checks. The right choice isn't about the highest number, it's about matching the strategy to your timeline. Monthly dividends feel incredible, but if they're coming from declining share prices while you're trying to build wealth, you're winning the battle and losing the war. Know your phase. Pick your strategy. Let the monthly payments compound or support, depending on what your financial life actually needs right now.